Welcome back, friends. So let's look at the quite cumbersome calculation that is done to get national income. So we first start with the gross domestic product at market price. First of all, what we do is we subtract indirect tax from it, and then we add indirect subsidies to it. The reason why we subtract indirect tax is that when tax is imposed on a commodity, it makes the price of the commodity increase. So if you want to get the real value of the commodity, we need to remove the tax that was imposed on that commodity. And the reason why we add subsidies is that you know what subsidy is? Subsidy is money or any assistance the government gives to producers to encourage them to produce more. So if tax overestimates the price, subsidies also underestimate the price. So to get the real value of the commodity, we need to add subsidies to it. So subtracting indirect tax and adding indirect subsidies to it gives us gross domestic product at factor cost. In other words, if you want to change anything of market price to factor cost, you have to subtract indirect tax from that and then add subsidies to it. Now, having gross domestic product at factor cost, we need to add net income from abroad. Let me explain net income from abroad. Now, what we are doing is we want to calculate national income. That is income accruing to the citizens of the country only, and not something produced or earned by someone who is a non-citizen of the country. So, to change the domestic to national, we need to subtract all income received by foreigners in the country. All income received, all because the money they are receiving, they will take it to their country. So we need to subtract income received by foreigners in the country. That is the factor income paid abroad we have here. And to get the clear picture, the right and exact picture also, we need to add income received by Ghanaians who are not in Ghana because they are citizens of the country. So that is the factor income from abroad. This is positive, meaning we are adding it, and this is negative, factor income paid abroad, meaning we are subtracting income received by foreigners in the country. So after performing that, in summary, that is the net income from abroad. Adding the net income from abroad to the gross domestic product at factor cost gives us the gross national product at factor cost. Again, I mention again that to change something domestic to national, we subtract income paid abroad and then we add income received from abroad by our citizens in the country. And always to get gross of something to be changed to net, we subtract depreciation. Depreciation is the reduction in the value of capital. Whilst you use capital, did it reduce in value? Subtracting depreciation from gross national product at factor cost gives us net national product at factor cost. Right. So basically, that is how to end up getting the exact national income of a country. But in reality, this is not possible to calculate because you can't go to every country and ask every Ghanaian in the country how much are you earning. It's not possible. So normally we use the gross domestic product in our calculations. That is in real economies. Yes. So the expenditure approach looks at the expenditure, consumption expenditure. This C represents consumption, I represents investment. So consumption expenditure is the consumption of individuals in the country. Investment expenditure is the expenditure of firms in the country. G is government expenditure of government, and also X is export expenditure. So expenditure involved in exporting minus M. M is import expenditure involved in importing. Alright, and the output approach looks at what is produced in the country at factor cost, the real value of what is produced in the country. subtracting tax from it and adding subsidies to it. And with the income approach, we look at, so the income approach looks at the wages received, interest received, rent received, and profit received. And if this calculation is done very well, this is the true reflection of the net national product at factor cost. That is the monies received by Ghanaians all over the world, excluding monies received by foreigners in Ghana. Right, so we have the net national product at factor cost. Sometimes it is important to perform some more calculations on the net national product at factor cost to get to know what monies is in the pockets of people. So the net national product at factor cost, we can subtract retained profits from it. That is profits that are plowed back into the business. When we subtract that, we can as well subtract social insurance. In Ghana, it's called Social Security SSNIT. We can subtract that also from it. Because the SSNIT does not come into your pocket, it goes to a company. So that one can also be subtracted from it. Right, then we subtract direct business taxes from it. Though you've earned profit, though you've earned this income, there is a tax you need to pay. That one also does not come into your pocket, so that one is also subtracted from it. Then we add transfer payments. Transfer payments are payments the government makes to people who have not performed an economic activity. So because they didn't produce anything, but government has given them some money, we add it to what is available, because we want to know the money that are in the hands or in the pockets of people. So doing all this complex calculation gives us personal income. Personal income. What you have received, what is in your hands. But normally when you receive your personal income also, direct personal taxes are subtracted from it. There are some personal taxes you pay, even if you are an employee, especially if you are working in a government agency. Before the money gets into your hand, the tax is already deducted. So subtracting direct personal tax from personal income, the final thing we have is disposable personal income. That is the money in your pocket. And when we subtract consumption from disposable personal income, the final thing we have is your savings. After consuming what you have in your pocket, what you are left with is what you save. So this is also an interesting aspect of national income. It's just to give you an understanding of how we can compute to know how much people are saving and how much people are consuming. Alright, so let's look into the income approach. The income approach, we look at the income or the factors of production received, wage, interest, rent, and also profit. So this is the net national product at factor cost, as we mentioned. Profits are normally stated net of depreciation. Net of depreciation means that after depreciation or capital consumption allowances are subtracted from the income. That is when you can state your profit. You can't state your profit if one machine is destroyed and you earn money. You can only state it after subtracting the money you use to repair that machine. That is depreciation. Right. So if the figures exclude net income from abroad, if the figures you have exclude does not include net income from abroad, then what you have is not net national product, but rather net domestic product at factor cost. So if you want to get your net national product at factor cost, what you need to do is always add your net income from abroad to your net domestic product at factor cost. It gives you your net national product at factor cost, which is a true reflection of national income. Again, as I mentioned to you, to change domestic to national, always add net national income from abroad. And net national income from abroad is the income of citizens, Ghanaians in other countries, minus the income of non-citizens in Ghana. Right. Let's look at the output approach. The total value of the output approach looks at the total value of final goods and services produced. Output means what has been produced. So no matter what, and please note that it is not only goods that are being produced, services as well. So those that are produced by the primary sector, secondary sector, tertiary sector, they all are aggregated and their value are taken as national income. So in order to avoid double counting, the value added method is adapted to exclude intermediate goods. Let me just explain that to you. So there are some goods that are made from other goods, like let me talk about gold. Gold is used to produce jewelries. So if you take the value of jewelries on the market, say it is the gold itself was had a value of 100 Ghana cedis, and when it was used to produce the jewelry commands a price of 200 Ghana cedis. If you take the price of the jewelry and you take the price of the gold also, because the gold was also sold, you are doing double counting. The 200 Ghana cedi of the jewelry includes the gold, the 100 Ghana cedi gold that was used to do it. So in order to avoid double counting, is either you take the final value of what has been produced, the final commodity, the value of the final commodity, that is the jewelry, and you ignore the gold, or you take the gold, which is 100 Ghana cedis, and when you get to the jewelry, you will not take the 200 Ghana cedis, but you ask yourself, what value was added to the gold to produce the jewelry? You realize that 100 Ghana cedi value was added to the gold to produce the jewelry. So you take the gold, which is 100 Ghana cedis, and the value added to the gold to produce the jewelry, which is also 100 Ghana cedis. So 100 plus 100 is 200. This is used to avoid double counting. Right. So GDP at factor cost plus indirect tax minus indirect subsidies gives us GDP at market prices. Remember when we did the calculation here, when we did this calculation, we subtracted indirect tax from GDP at market price, and then we added subsidy. So now if you have the factor cost and you want to get back to market price, you add indirect tax and you subtract subsidy. That is for the output approach. So in the output approach, it is very important to distinguish between indirect, direct, business and personal taxes. Look here. Here we did not subtract direct tax, we subtracted indirect tax. And for your information, indirect tax is not tax paid paid with your money to the tax agency or the revenue collection agency. Even if you buy banana, you paid indirect tax. Indirect tax are taxes imposed on goods and services. So when you buy a commodity, the tax is imposed on the good and service. That is why the commodity is that expensive. So you paid your indirect tax. And that is why we subtract indirect tax from the value of the commodity to get the right value of the commodity, because the price cannot really determine the value of the commodity. The price is the value of the commodity plus tax. Let's pause here and we'll continue in the next slide.